Hello everyone, and welcome to your Glassnode video report for the week Onchain newsletter, week 28. I'm your host Checkmate, and we're recording today on the 13th of July, 2021. So this week we're seeing the market squeeze into an extremely tight consolidation range. We're seeing a lot of the volatility and pricing really closing out. And what we are seeing is a quietening down across many sectors of the market. It's starting to resemble somewhat of a calm before the storm. It's highly probable that there's going to be volatility in the market down the road. And what we're really seeing is a lot of metrics starting to squeeze in and showing some early signs of trend reversals, trend shifts. And what we look at this week is a fairly broad scope. We look across all sectors of the Bitcoin market to just get a bit of a feel for what the overall sentiment is and where some of these movements and volatility triggers may appear. So we look briefly at the mining market, which we've covered over the last few weeks. So we start to touch on where those miners are actually at in terms of hash rate recovery, what in terms of their spending patterns is it looking like. We look at exchange balances, some of the changing flows, and some of the trends that are starting to develop in terms of renewed interest in outflows. We look at derivatives markets, which have a very, very quiet period of both volume and open interest, and this occurs on both futures and options markets. And lastly, we spend some time in the hodl waves, where we go on a bit of a deep dive looking at coin maturation, investor holding patterns, and the general behavior of these different segments of the market and how they're currently considering the consolidation. So let's move across to Glassnode Studio and we'll have a look at our week Onchain dashboard. So here we are in the week Onchain dashboard. We've had the Bitcoin price this week consolidating between about 32,000 and 35,000, so a relatively narrow range compared to what we've seen recently. And what we really focus on this week is that broad picture, what's going on in the various sectors of the market. Now, at the time of writing, what we were looking with the mean hash rate, we started to see this bounce off the bottom and noting that there will be some natural variability in block times, particularly during periods of high disruption, plus when the difficulty adjustment is still in the process of working through and reaching that equilibrium for block intervals. What we're generally seeing is a stabilization somewhere between around 100 exahash. So down from the total high of 180 exahash or thereabouts. So we're starting to see the mining market stabilizing. And this is somewhere between a 50 and about a 40% reduction in the overall hash rate. Now, what we've been talking about in previous newsletter editions is what's the potential headwind from miners who are heavily affected by this current ban that's going on in China. They're currently in a position of moving their mining equipment. They need to relocate, they need to reestablish operations, and that's going to provide some kind of headwind. Now, if we look at our miner net position change, this is going to give us a bit of insight into the balance between the two different sets of miners we have on the network at the moment. We have our offline miners in China who are currently incurring fairly substantial logistical costs and therefore may have to liquidate parts of their treasury to actually cover that. We've also got the miners who are still operational who've just seen half of their competition drop off the network. And their revenue has more or less seen an almost 2 times boost. So it's a quite profitable time to be an operational miner. And if we think about what this actually means in terms of headwind and supply, we've started to see a slight increase or the degree of accumulation in the miner net position change. Now, what this is really telling us that after a period of distribution throughout this consolidation range, we're actually seeing that more coins are being held onto than are being liquidated. So of that balance of miners who remain operational, there's a balance of miners who are offline and not necessarily having to liquidate large portions of their treasury. Perhaps they've found buyers for their machines. Perhaps they've been able to relocate or arrange contracts and cover some of their current costs. Perhaps that when they are selling their treasuries, the miners who are currently operational are simply on net actually preserving or holding on to more of those coins, offsetting any of the treasury selling that's going on from the offline miner. So it's providing us that little bit of an insight. Now, we've seen a slight retracement in our mean hash rate over this week. What we will see is how long does it take this hash rate to actually recover. That's going to give us an insight into how quickly the miners can essentially come back online, how quickly they're going to be able to relocate their machines, and when some of those headwinds in terms of logistical costs will start to dissipate. So the mining net position change is telling us about the balance between the offline and the online miners in terms of their selling pressure. Are we seeing an overall accumulation or distribution? And the recovery of the hash rate will give us an insight into how quickly some of those logistical costs and relocation expenses and the rest of it are essentially able to be mitigated because machines can get back online, they can return to generating an income, and that can alleviate some of the stress on the financial stress on these miners. Now, if we then jump to our exchange reserve, so a big theme throughout 2020 and 2021 was the fairly relentless depletion of balances on exchanges. We saw that there was a very strong downtrend right from about mid-2020 all the way through to late April in 2021. Now, what we then saw is an inflow of around 140,000 BTC on aggregate. Now, over the last couple of months, it's more or less traded sideways as we've been in this consolidation range. So there's been coins coming in, there's been people withdrawing, and we really have started to find a little bit of a downtrend stepping in. So of the total 140,000 BTC that flowed in since April, we've seen around 40,000 of those now flow out. So there is a current sign that there's a exchange depletion that's going on. We're starting to see more coins coming out. If we then compare that to our net transfer volume to and from exchanges, now we've got a 14-day moving average on this, and this is to really make sure that what we're looking at is a sustained trend. We're not talking about single days. What we're really looking for is the overall trend, and we can see particularly through 2020, the periods of net outflows were sustained for an extended period of time. We can certainly see that in 2020, we had a fairly substantial, down around 5,000 BTC per day on this 14-day average. We then dropped down to somewhere around a 2,500 outflow with occasional bouts of inflows particularly during large rallies. And then through the period of April and May, and then into early June, we actually saw a fairly substantial inflow. This represents this 140,000 BTC that flowed in. We really saw a substantial inflow that actually resulted in, or was a contributing factor to, the overall 50% decline in prices. Now, what we've seen over the last couple of weeks is, on a 14-day basis, a resumption of this downtrend, which is starting to manifest as this 40,000 BTC outflow. And for context, that's around 28% or thereabouts of what flowed in. So what that's telling us is that over the last couple of months, as we've been in this consolidation range, some 30% has essentially been reaccumulated. That may give some indication that it's going to take a little bit more time for this overall correction, and perhaps just the length of time it'll take to reaccumulate those coins. And whether that's going to provide additional selling pressure in the near term. This is providing us early signs that perhaps there's a bit of a trend to the outflow. So on the derivatives markets, we still exist in terms of the open interest on both options and futures. We're still down around 60% or 67% in options in total open interest relative to the peak that we saw, which came in around the all-time high at around 64,000. So we're still in this range where overall speculation has been largely flushed out of the system. And we're also seeing that futures volume is in a structural downtrend over the period of this consolidation. Options volume is similarly in a fairly structural downtrend. And what this is really telling us is that we're seeing a large amount of the speculation capital has been flushed out. We saw a lot of liquidations and a lot of cascades as we sold off down from that May peak. And what we've really seen is that has not built up to the same extent. We've seen that flush out of a lot of the leverage. And what that's really indicating is that much of the market volatility that may come is most likely to be spot driven. It's less likely to be a large leverage flush, whether it's a short squeeze or a long squeeze. In general, the moves that we see from here are more likely to be driven by spot volumes and true demand and supply balances. So that's providing us a little bit of an insight into what's actually going to drive this next rally. Again, it's important to keep an eye on whether we see large increases or decreases in the overall open interest. That's telling us a little bit about whether there's risk neutral trades. If it remains fairly flat and we get a significant move in either direction, it may well be saying that a lot of the current open interest is actually risk neutral cash and carry trades. It could also tell us if it does really decline substantially, that we're seeing that again, and maybe that last leverage flush, maybe a lot of people who've remained long and those positions continue to get built up if we sell off, or conversely, if we get a short squeeze, do we see a significant change in that open interest and volume? So at the moment, derivatives markets are fairly quiet. It's tending to suggest that any movements from here are probably more likely to be driven by spot volumes rather than some leverage derivative flush. And finally, we're going to look at the supply dynamics. So what we've looked at in the last few sections is the mining market. We've looked at trading volumes on derivatives. We've looked at exchange balances. What we're now going to look at is a few metrics that relate to the age of coins, particularly coin maturation, holding patterns. What is the general sentiment that we can determine on-chain by people who currently hold supply? Now, we've got two metrics here, the average spent output lifespan and the entity adjusted variant of it. Now, the reason that I've chosen the ASOL metric in particular is it's focused on a per UTXO basis. Now, over the last couple of weeks, and we touched on this in week 27, it's been fairly quiet on chain. Overall transaction volume that's been flowing through both Bitcoin and Ethereum chains, we've generally seen a fairly quiet mempool. Now, if we use a metric, say, for example, coin days destroyed, that's looking at the total number of coin days that are destroyed. Now, if you have a very, very quiet mempool, which is quite typical of consolidation ranges and periods of quiet volatility, when you have a very quiet mempool, there's just not going to be many coin days destroyed. And using that metric may otherwise tell you that it looks like there's not a lot of old coins on the move, but that's actually because it's just a quiet mempool in aggregate. So using a total based metric like coin days destroyed may well lead you to the wrong conclusion. Now, what the average spent output lifespan is telling us is of all the transactions that were spent on a UTXO basis, so on a per output basis, what is the average age? So it's largely indifferent. It's telling us the proportion, what is the average age of the coins that were spent, rather than trying to do an absolute value of the coin days that were destroyed. So it's a better metric for an all-weather tool. It doesn't particularly matter how busy the mempool is because it's all relative to what was going on that particular day. It's the average age on that particular day. And in particular, during quiet mempool periods, it's actually telling us a lot of signal. It's removed a lot of the speculation potential, a lot of the froth. And what we're seeing is very purposeful transactions. People who are still sticking around after a 50% drawdown and still making decisions whether to send coins to exchanges or withdraw them. So ASOL provides us with this insight. Now, simultaneously, we have the standard ASOL metric and the entity adjusted metric. Now, what the entity adjusted metric will tell us is a much cleaner signal because it removes many of the financial institutions and the exchanges and various other similar entities who would be using this current low fee environment and low activity environment to do a lot of wallet management. They'll be shifting around coins, consolidating UTXOs and moving their overall balances around. It's an opportune time to take advantage of that low fee environment. And what we can see on both of these metrics is actually a fairly sustained downtrend. We saw a slight uptick on the standard ASOL metric this week, which didn't really show up to the same magnitude on our entity adjusted metric. And you can see that we're down here around 26 days. And on the standard ASOL metric, we're around 35 days as the average age. But you can see that this is not quite the same as the levels that we hit during particularly these peak in rallies. So at the 42,000 mark, we obviously spiked above 80 days. And during just before the May sell-off, we're up around the high 50s. So it's giving us a bit of a scale on what's the overall average age of coins that are on the move. And what we generally want to see for positive price action is this continue to trend down, which is really what we're seeing, particularly across the entity adjusted version. And that's telling us that older coins are generally remaining fairly dormant. And ultimately, if those older coins, which are otherwise illiquid, start coming back to life, and we're seeing the average age start to trend higher, that's really telling us that perhaps there's a loss of conviction in some of those older hands. So at the moment, we're not seeing that, but that's certainly a metric to be paying attention to. If we get a significant spike in ASOL, it may tell us that those older coins are coming back into circulation, whether it's to take exit liquidity on a rally or perhaps a loss of conviction if the market trades lower. So that'll give us a bit of an insight as this volatility starts to creep back into the market. And finally, we're going to look at the hodl waves, but I actually want to jump to the full scale chart here and do a bit of a deep dive and look at some different categories of holders. So one of the really neat tricks when it comes to the hodl waves is we can actually look at these different categories of age brackets by turning on and off the legend. So I actually want to trend from oldest to youngest and just get a bit of a scale on how these coins are all moving through the system and look at some of the maturation patterns that we're seeing in the existing coin supply. Now, I want to start with our 10 years to 7 year, or our 5 year to our 10 year age bracket. And what I want to note with these is disproportionately, these are going to represent very, very old coins, and in a high percentage of these are probably going to be lost. Now, of course, there's going to be some magnitude of them that will remain in circulation, and we can see that it's not exactly following the nice pattern of the original mining algorithm. So you can see that there is a very similar correlation of this curve to the initial supply that was coming out from Bitcoin and from the early miners. So this is how we can tell that a very large portion of these are more than likely lost because it really has a similar trend and similar flow to what we saw over the first 4 to 5 years of Bitcoin's history. So what we'll now do is transition to looking at our middle-aged coins. And these are what I classify as 1 to 2 year and 6 months to 12 months. So these are coins that have been accumulated with at least 6 months worth of buffer zone, but they haven't quite crossed that 2 year threshold. So they're still within recent times. And it gives us a bit of an indication of what was going on, particularly with the late last cycle's buyers, people who were essentially buying the tail end of the bear market and then are now realizing a fairly healthy profit margin. So let's look at this on a 3-year basis. And what we can really see is that this particular class was generally distributing overall through 2019, 2020. And what we've then seen is a significant spend. So as we rallied out of the 20,000 all-time high, we saw these coins in particular really start to liquidate their holdings. Now, as we plateaued, and let's just bring it back to this 42,000 peak, many of our lifespan metrics also really spiked during this period of time. So this really lines up with who the predominant spenders were during that period of time, and they were this 1 year to 2 year bracket. People who have accumulated back in the 2019 and late 2018, so really realizing profits on coins that may have been accumulated between $3,000 and $5,000, and then starting to liquidate them on the rally up to 42,000. So still a fairly healthy profit multiple. Now we can see that these started to slow down, particularly as we started forming this topping pattern. So the distribution of this class and this cohort really slowed down quite substantially during this time. And what we're starting to see is in the 6 months to 12 months coins. So these are coins that were accumulated as we broke out of the all-time high in January and soon to be February. These coins are actually starting to spike higher, and the overall rate of change of these metrics, what we would like to see is these 6 to 12 months coins will give us an indication of how many coins were accumulated during the early phase of the 2021 bull market. And bearing in mind that some of these are going to start moving to be underwater at this point in time. 6 months ago, we were starting to rally up towards the 50,000, 55,000 range. The scope of how high this 6 to 12 month band starts to reach will give us an indication about how many of those coins that were accumulated in the early bull actually remain in cold storage and held. So it's going to give us an indication, the higher that this trends, it's really telling us that there is coin maturation going on, particularly following a period of plateauing. It's telling us that the distribution cycle has largely switched. And if we compare the magnitude of this overall sell-off to the magnitude of how much it's now starting to rise back up, it's giving us an indication that perhaps we're starting to see that switch from distribution into a more hodling type behavior in this asset class. So this is the early sign in these middle-aged coins. It's telling us people who've accumulated in near enough history, but have still seen a bit of volatility, and it clearly have realized some profits during the early bull market, transitioned into a period of holding, and are now actually transitioning to start really hanging on to those coins, and they're allowing them to mature in colder storage. And finally, we're going to look at our young coins, which I've classified everything from 1 week old right the way through to our 6 month age bracket. So these are coins that were really accumulated during the meat of this bull market. A large proportion of these are going to be underwater, having accumulated up in the $55,000, $60,000 top. And what we really want to see is two things on this front. So what we've looked at is a distribution cycle from the 1 to 2 year old coins, and obviously older hands who are realizing profits during the early bull. And there is a wealth transfer. So we see the growth in these younger coins, the overall supply that's held by these relatively new investors really starts to spike over this period of time. And this is this wealth transfer as it transfers from older hands to newer hands. What we saw during the plateauing of the top is we actually saw these entire bands in aggregate start to level out. And since that point, we've actually seen a fairly substantial downtrend, first starting in the 1 week to 1 month, then progressing into the 1 month to 3 month, and we're starting to see that downtrend progress to the 3 to 6 month. Now, what would be the most positive sign for this in terms of overall price appreciation is we want to see more of these coins move into cold storage and stay there. And in particular, when they start to cross that 5-6 month threshold, what we otherwise classify as our long-term holder supply, statistically speaking, they become more likely to remain in that cold storage state. So seeing this decline that's progressing and essentially transitioning from the younger bands up to the slightly higher bands is a signal of coin maturation. It's showing that a fairly reasonable number of these coins, whilst around 32% of the overall supply is held by these relatively new investors, we are seeing a gradual decline of these. Now, what that's telling us is that coins are slowly transitioning through the different age brackets. And the most positive sign is we actually want to see this. We looked at our 6 to 12 month band that was expanding in our previous section. We would actually like to see these coins gradually transition into that bracket and then continue to mature over time. So an overall reduction in these particularly young bands is a positive signal. However, conversely, if we do start to see very high spikes, it's important to note when looking at age bands That maturation takes time. In order for a coin to transition into the 1 to 3 month band, it needs to be at least 1 month old. So that lowest bracket, the lowest band of the bracket is essentially the threshold. We need to wait and see that there's a lag in the overall data for coin maturation. Conversely, when we see an increase, as we did during the early phase of this market cycle, the spending of coins from 5 years old or 2 years old to become immediately a 24-hour-old coin is instantaneous. We see this immediately. So when we see a large spike in these younger coin brackets, it's an immediate impact telling us that something that was older, or a coin that was older, has been spent and transitioned into that younger coin state. So for a more bullish projection, what we'd like to see is a continued reduction of a progression of this maturation cycle, a reduction in these younger coins, which means they're transitioning to become older and moving into cold storage and staying there. Conversely, a more bearish type scenario would be rapid increases in these younger coin bands, suggesting that older coins are being spent and essentially transitioning into those young coin brackets. So that concludes our week 28 report. Thank you for tuning in, and I look forward to seeing you in the next one. Cheers.